Hey everyone, my name is Keith Beggs. I'm the founder and CEO of Steadfast Wealth Strategies, and I wanted to put this short presentation together. Read this article in the Wall Street Journal over the weekend talking about the 1% advisor fee, and I really thought it pertains very well to something that we talk a lot about to our clients, and that is how much fees inhibit growth on their safe money. Right? When we say safe money, this is our non-equity portion of our portfolio. Right? So typically in a portfolio we'll have bonds and equities, right? That's a typical breakdown. The bonds are used to offset volatility so we don't have so much risk and market volatility in our portfolio, and we're trying to get a small or reasonable rate of return from that portion of our assets. And Wall Street has done a great job of convincing people that there are no other alternatives than bonds. And so you just kind of do the bond portfolio, you expect to get a 3% rate of return, and there's just a 1% fee on average charged with that. And I'm here to say I think there is an alternative. There's a lot of talk about the alternative, and it's the fastest market growing segment out there right now. But again, they've done a good job of tarnishing the name annuity. So let's just look at some math over the last 10 years and over the last 12 months and give you guys the data, then you guys can make the decision for yourself. So bonds versus annuities, what's the best place for your safe money? So what the Wall Street Journal said was, according to their research, bonds had produced a 3.4% annualized rate of return through the 10-year time period ending June 30th. Okay? So what does that mean? Well, it means if you had $100,000, right, then you would have earned $3,400 on your bond portion of your investment. Okay? So $3,400. Now, they also said that the average fee for this person, for this investor, is 1.04%. Okay, I said 1%, but they say 1.04, meaning the total cost in fees for this portion of their asset was $1,075.36. So if I take out that out of the $3,400, my net gain was $2,300 and $2,324. So $2,324. That is almost 30% of the earnings and fees. It's actually a little bit over 30% of the earnings and fees. When you sit down with this advisor and they said, hey, look, we're going to build a bond portfolio, or put about 50% of your assets in there, and most retirees will have somewhere between 30 and 60 to maybe 70% of their money in safe money. And on that portion of your money, whatever it makes, we're going to keep about 30% of that. Would you have signed up? And the answer is no way. You would never sign up. And that's why they don't say it that way. Right? They're strictly taught to say, hey, we're just going to charge a 1% asset or management fee on that portion. That doesn't include any taxes if it's non-qualified, any fees or trading costs or fund fees that may be involved as well. Okay? So again, we're netting 2.3%. Now, they've also said that they expect over the next 10 years, according to Morningstar, bonds to do 1.8%. So if the bond portfolio over the next 10 years annualized does 1.8, and I'm paying 1.04, what am I getting? 0.76% rate of return. Now again, this is safe money, right? The goal of this money is not to lose and to offset volatility, but man, shouldn't we expect a little bit more out of it? Right? Shouldn't we expect to get a little bit higher rate of return out of that? And are there any opportunities to do that? Well, we believe there are, right? So if you look at an index annuity, right, that's got some great opportunities out there. So there are good and bad annuities, just like there are good and bad speedboats, like there are good and bad anything, right? You got to find the right annuity that fits you. I recommend working with a fiduciary. We are a fiduciary company, right? So it's our job to not only find the best style of product for you, whether that's equities, bonds, or annuities, but then also make sure that the product that we choose meets your needs the best. So when we're looking at bonds alternatives, what do we want? We want a product with zero caps, right? That gives us the most upside potential. We want no downside risk, and we want no fees. We want no money coming out of this contract unless you take the money out of the contract. Okay? So with those type of things, historically, we're able to get a 4 to 6% annualized rate of return. That doesn't mean we hit 4 to 6 every year. It means over a 10-year time period. If we look back on it, it's going to be like getting 4 to 6% on an annualized basis. Okay? There are no guarantees of returns in this, right? But we do have a 0% floor, and then we're tied to an index, and as the index performs, so does our contract. Okay? So let's say we get 4%. Let's say we do on the low end, right, of the opportunity here. Well, we have $100,000, we make 4%, we make $4,000. That's a $1,675 increase over the bond portfolio over the last 10 years on an annualized basis. Times that by 10, that's over $16,000 in additional income. If you have $1 million portfolio with a 50-50 blend, you can times 16 times 5, right? We're looking at almost an $80,000 difference there, right? It's a 72% increase in our return potential. And that's what we believe will be on the low end for you. So let's look at the last 12 months. According to the Vanguard Total Bond Index, bonds are down 0.76%. So bonds actually have the ability to lose money. You put your fee on top of that, you're down negative 1.8% over the last 12 months. Big difference right there. We can't lose money in the index annuity product. So, Athena Annuity, they have a Schiller Index. We get about a 67% participation in that index. After the participation rate, we're up 13.26% over the last 12-month time period ending today. That I'm doing this video on August 9th. The total difference after fees is 15.06%. Now, does that mean we're going to do that every year? No. Does it mean it's going to happen again? Well, no, we can't guarantee anything, right? Because we're tied to an index. But it shows you the potential and the opportunity that you're leaving on the side or on the floor or out of your portfolio if we're only doing bonds, right? Now, the index annuity is not a perfect investment, right? And the way they get people off of it is they talk about the surrender charge. But these things offer 10% free liquidity every year of the initial deposit on the ones that we use. So if you put in $100,000, we can take $10,000 withdrawals out each year. So we got to make sure we cover the liquidity issue, right? Again, there's no perfect investment out there. But in terms of getting actual returns that can help your portfolio and help your retirement, there's no better potential without risk out there than this right here. So if you're not looking at this as a bond alternative, I think you're missing a huge opportunity. If you have questions about this, where you want to talk to us and see if this might be a good fit, we would love to do that with you. You can reach me at keith@steadfastws.com, or you can just reply to this email. So hopefully this was informative for you. And if you'd like to copy the article, reach out. I'll send you a copy of the Wall Street Journal article as well. So hope you have a great day. Talk to you soon.